Oh, what's up, Devin? Can you hear me? Devin, can you hear me?
Yes, sir.
All right on. Thought my internet was dead.
You were frozen there for a little while, so on my
Y'all
end
ready?
anyway. So
We're
let's
live
do
on Facebook. I'm gonna go ahead and broadcast y'all.
Am I kicking it off, or is Abel?
I can kick it off.
Awesome. Let's do it.
All right, here
Do
we
I
go.
need to share this, Ruben?
I'll share the slide deck.
Okay.
All right. All right.
Hello. Hi, everyone. I want to give everyone just 30 seconds here before we kind of kick everything off. Welcome to our virtual live meetup here. And while we get going, so thank you very much, everyone, for joining. We appreciate the opportunity to meet during what we hope is a lunch break for some, and for others, a little extra free time that we have during this pandemic while we quarantine at the house. We want to make sure we stay sharp, stay mentally active, and soak in as much as education as we can. So welcome to our apartment educators monthly meetup, which we're now trying to go to bi-weekly. And this topic is basically how to buy an apartment complex, how that's changed during the COVID-19 pandemic. So we thought we would share some knowledge with you guys. And my name's Abel Pacheco, one of the co-hosts here. And then let me allow Devin Elder to introduce himself as well.
Awesome. Thanks, Abel. Hey, this is Devin Elder, one of the co-founders of Apartment Educators and an apartment investor in San Antonio, Texas. So we've got some great content to tee up and share with you guys today.
Yeah. So kind of diving right in, this was originally our meetup that we were meeting in person. We've done this for about a year, had some pretty successful, coming together, some meetings in San Antonio, Texas. And we were local. There's a lot of, critical mass here for apartment complex investing, a lot of opportunities. And until last month, everything was in person, face to face. And now this really gave us an opportunity to have a bigger audience, make sure we're sharing with people outside of San Antonio, Texas. And it's a really good opportunity for us to come together for our multifamily meetup. There is a meetup page as well. We haven't figured out quite the networking portion of it, but we believe by next month, we may have an opportunity to connect everyone together, and that way everyone can still do the networking portion. But we really started the meetup for an opportunity to educate investors that are investing with us, other operators or potential future operators that wanted to learn as much as possible about doing an apartment complex deal on your own. And then also the opportunity to network investors, deal operators, people that want to come together and do these deals. It takes a team, so that's really why we put together this multifamily meetup, and that was the original vision. And it's still going strong, and we want to make sure that we're active during this time. And the cadence right now, we're trying to do these bi-weekly, now that we have the opportunity to do them via Zoom. So by attending the meetup, man, we just want to provide, like I said, as much education as possible. And that was really the goal for our meetups. Devin, did I miss anything here?
No, that's great. At some point we'll make these back to live, but we can still deliver a lot of value here virtually. So it's good.
Absolutely. So we'll move on to the next slide here. So first, thanking our sponsor. So we do have Apartment Educators as our sponsors, and essentially they provide really good education on how to do deals, how to pull a team together, how to create really an organization that can all come together that is like-minded, all wanting to accomplish the same vision. So we just want to say thank you to them and create a really great ecosystem for them. But Devin, let you talk a little bit about our sponsor, since you're heavily involved in apartment educators.
Yeah, so I've been getting requests for years for kind of coaching and mentoring around buying and managing and running apartment complexes as investments. Never really had the time or the bandwidth to build out the team and the systems that were necessary to deliver value there. But finally last year, my partner Ruben Dominguez and I started the company with the vision to be able to grow an ecosystem where we can bring on folks, not only as investors, which we have hundreds of investors, but now as folks that want to kind of step up into running deals and running their own deals. And we'll partner with them and all kinds of fun stuff like that. So we've created that ecosystem with apartment educators. It's really a one-stop shop to come in with no experience and get the tools and the team and the processes to go out and start doing that. So we've got that up and running, and it's been awesome. It's been a lot of fun to be a part of and see the growth and success of our students. We are accepting applications now for a handful of very limited spots we have for new coaching students. So if that's of interest to you, you can go to apartmenteducators.com and you'll see anything you need there to get in contact with us and see if it's a fit.
Very good.
So I can kind of kick this off real quick. A little bit about me. My name's Devin Elder. I run a management company called DJE Texas Management Group. I was born and raised in San Antonio and have been doing this since 2012 and now own thousands of units of apartment doors, as we call them. Thousands of doors. Valuation is around $130 million on that portfolio. And I got into real estate investing really, I guess, out of pain of being in the corporate world. Ran into a lot of limitations there and frustrations that kind of forced me into entrepreneurship. And so that's been my path. And I'm here with you guys today, taking my time out from my company and my lunchtime, just like you guys are, because the likelihood of me being in a partnership with one of you guys on this call right now is very high. Everything successful that's happened for me in the multifamily world has come through some kind of a partnership or meeting somebody. And so that's why we do these. That's why I do these things, to be able to connect with good folks that maybe are potential future partners on deals where we can go out and create value in a community and make money for stakeholders. It's a lot of fun to put that together.
And to introduce myself, my name is Abel Pacheco. I am the president and founder of Five Talents Wealth. So essentially, about me, I'm from Corpus Christi, Texas, San Antonio, Texas. I've lived here for the past 20 years, so 20 in Corpus, 20 in San Antonio. And I grew up in the IT professional world, sales. I did that for about 13, 14 years and have been real estate investing since 2008. So because of multifamily, I've been able to me and my wife are invested in about $59 million of multifamily apartment buildings, and we're invested in about 800 doors total. I'm passive in 400 and a general partner in another 400 or so. Had a nice successful IT sales run. We went from about $5 million in sales in 2010 to about $57 million in annual sales in 2016. And throughout that process had been investing since 2008. So just now transitioning into multifamily over the past few years. And I also, like Devin, had realized the power of a team. So part of my why I'm doing this is I love to serve other people. And some individuals helped me throughout the process get where I am today in real estate. And so I like to give back. And then also I want to make as much money as possible through investing. And unfortunately, I can't do that on my own. It takes a team. So this is part of why I'm here. So I'm always looking for other investors, always looking for new potential teammates, and then always trying to give back as much as possible. So nice to meet everyone. Thank you very much.
So why multifamily? The reasons that we choose multifamily investing are the same as they were 10 years ago as they are right now in 2020, even in the midst of whatever's going on with coronavirus. But number one, we want returns. So we want a good return for our money. We want to put our money to work and get a stronger return than we can get in a CD or maybe even the stock market. So we're getting returns in terms of cash flow, monthly or quarterly checks that the property's spitting off. And we're getting in terms of equity, creating more value. And we get equity in these apartments just like we do in your home. It's a passive investment. So for all the people on the team, the majority are passive investors. They're just putting in a certain amount and they're getting their money with no work at all. So that's a fantastic position to be in. We're getting tax benefits, massive tax benefits, sometimes in the form of depreciation. And this is a safe asset. So it's a real thing, dirt, a building, an income stream. It's not some ephemeral stock market deal that's going to be wildly up and down in terms of valuations. It's definitely a slower moving, safer asset. And those are kind of the high level why we like to do multifamily in the past and why we still like it today. So certainly things have changed. Now we're doing this April, early April. Really the COVID stuff kind of came into play like 30 days ago. So, I mean, a lot has changed very, very quickly. It's difficult to say when everybody's going to get back to work, but we hope that's nearer term in terms of maybe weeks. And then of course, there's going to be ripples throughout the global economy in terms of employment and things like that, it's a million variable equation. We don't know how it's going to turn out, but it has changed some things in the immediate term on how we're pursuing apartment complexes. One thing my firm's doing, as of this recording is just saying, hey, we're not writing offers right now. It's going to be at least several weeks until we're writing offers. We all want to get back in the game. Sellers, buyers, brokers, lenders, everybody wants to play ball. But a lot of firms on the acquisition side have just pushed pause, and on the sales side, some firms have done that too. So for the next couple of weeks, a lot of firms are just on pause. Now deals are still getting done. Brokers are doing virtual tours, things like that. I see deals closing. It's just obviously changed for this little period when we're sheltering in place, basically as humanity is sheltering in place. It's certainly going to impede some deals, but again, we think that's kind of like weeks and not years to be impacted there. Abel, on kind of the offers and earnest money and underwriting, I know you had some great points that maybe I'll kick it over to you for those components.
We have a couple of slides that are specifically talking about how to get into it here. But let me kind of, at least at the high level, right? We, as Devin mentioned, waiting the market out. We're not sure if, the new prices for apartment complex are going to be at a 5% discount, a 10% discount, if they all are at all. We believe so. Almost overnight, really, the market's changed from a seller's market to a buyer's market. And with that, most buyers are now expecting some kind of a discount. But obviously, because things aren't actually moving today, it's hard to forecast this. Is it going to be a 5%, a 10%? So I think that's where the market is just kind of waiting this out. And there's opportunity coming. We all believe that, as Devin mentioned, everyone wants to go do deals. The banks want to go do deals. Investors want to put their money in a safe asset. We're trying to figure out, what's the next apartment play to buy. But as time goes on, I think a lot of waters will be tested. So as we go to the next slide here, maybe digging into each of these individual components. So what do you really need to know as you're writing these opportunities? And I think that's important. You're trying to figure out a few of those things. When you're writing an offer, whether it's 3 weeks from now or 3 months, your purchase sale agreement has to be different than it was. Your underwriting is a different kind of conservative. Your due diligence that's going to be required today will be different. And then also the financing. So let's talk about each one, right? On a purchase sale agreement, let's talk about the earnest money. I think we used to get aggressive, and if you were getting aggressive on an offer, you were trying to beat out another offer. And one of the triggers or the offers that you could put down was non-refundable earnest money. I think that would be one of the major changes in an offer, is to say, look, I do not want to put down non-refundable earnest money in making an offer. The second one would be, in your purchase sale agreement, your LOI, whichever phase you're at, is you're looking for more time built in with potential extensions. So if you used to offer 45 or 60 days, now you may be offering, 90. You're trying to figure out how much time you can get with some potential extensions, even if you lose that time. So I would consider that. Another one would be, your in your purchase sale agreement, talking to your lawyer, legal counsel, to figure out a due diligence contingency and also a finance contingency, potentially even a corona contingency or an act of God clause. You want to talk to your legal counsel to make sure that you're covered. You want to make sure as many of those things as possible are in your purchase sale agreements. I think it used to be where sellers could control more of that and dismiss an offer. I think you're going to find that because of the buyer's market, they are going to be more amenable to making these changes and adding these things in. The second part would be, your underwriting. So before you make an offer, you want to be more conservative. And how can you be more conservative? You can do things like factor in your first year, as you're doing your pro forma 5-year, you're looking at your first year with no increase in rents. You may be able to start your first year with the previous existing T12s that were in place, and maybe even reduce them your first year, just to make sure that you're conservative enough to kind of work with potential lower occupancy rates or higher economic vacancy. As you're looking at that underwriting, you're trying to figure out, hey, what's the highest physical vacancy? What's the highest, or the lowest break-even point that I can actually do this deal and have enough renters to pay the note, to pay the mortgage, and continue moving forward, and be in the investment and make some money for all of us, our investors. So you want to look at things like, your maybe bad debt, increased concessions, a loss to lease may be higher. You're really trying to beat the deal up more in your underwriting. Your sensitivity analysis, your stress test have to be hard. And, like I said, the break-even occupancy. What's the minimum amount to pay the bills and stay the investment? You're also probably factoring lower, lower rents. You're in our old models, you may have had a 2% increase, potentially 3%. If you really thought things were cooking, you may want to factor in no increase in rents, for the first or maybe second year. So if you're staying more conservative through the underwriting, it will allow you to be more confident in your offer, in your price. So that way, if things start to go south for longer, if we're having to stay at home May and June, you want to make sure you can factor that in and be able to still work on the opportunity. And I think the next part of, as we're thinking about the offer writing, you're writing an offer, you need to do due diligence on your property. And that due diligence on your property is one of the things that's going to be very hard to do today. We would, for an example, you'd get a property manager. A good property manager will help you walk every unit. You can walk 100% of them. You can have some kind of plan necessary to know your capital expenses, your operating expenses, your deferred maintenance, maybe on every single unit down to the component. If you can't walk every single property because your property managers don't want to go in every unit, your renters don't want anybody coming in their units either. I wouldn't. How are you going to do that due diligence today? That is not something we have an answer for. It's just something to be aware of. That's changed today. So if you're accounting for that in your offer, potentially that is a lower offer to account for, the lack of ability to do due diligence. And if that's a risk that you're willing to take, you may get a great buy. And then you may also come out with a different unit mix, who knows? So those things are things to factor in. You may be able to hire a drone, look over the property, look at your roofing, things like that, look at the overall property, but how are you going to get in the actual units? And I think that's something that needs to be solved for. And I don't think it's going to be solved in the next few weeks, like Devin was mentioning, not writing offers now, right today. But, in the future, if this continues and occurs, and that'll be something we have to work through. Also, the last point on this one, as we dig into details, is the financing. So when we're looking at financing today, I would definitely factor in a few things. The banks wanting a higher debt service coverage ratio or DCSR, because if they want to ensure that they have less risk, they're going to want to make sure that you have enough equity in the deal to cover the mortgage and with a high enough rate so that if things go south, you've got that debt coverage ratio at a little bit higher. Maybe we're factoring at 1.25. You may want to factor in higher at some point as you're underwriting this. And also, I would just expect a lower loan to value on these deals. If you were factoring 70, 75, you may want to factor in an even a lower LTV, meaning you may have to raise more capital right now. You have to be better funded to make an offer. You have to be better funded for the loan. And, lenders, I've heard a few deals that are in flight, they're asking for post-closing liquidity, meaning the KPs or the key principals, they have to have extra funds or extra liquidity in the bank before they close. And those requirements are happening like the day before closing. So this is just something to be aware of as you're looking to finance the deals. I think most prudent and conservative investors, when you're talking to legal, they're probably going to build in a capital call in case you need it. We'd hope we never have to use it, but I would make sure that your PSA, your purchase sale agreement, all your PPM docs, your legal docs have capital calls built into it. And then also, I would highly recommend using a broker or pro that's navigated rough seas in the past. That's probably my biggest piece of advice. You want to know these things at a high level, but you also want to use a broker that has navigated these rough seas, that's already done it, that's maybe been through tough times, and then they can foresee what happened back then and help you with today's. So anyways, those are a few things on offers, earnest money, and underwriting. The times have definitely changed. It's not impossible, but it's definitely going to be a hike and some tough sledding. And if you factor into that, you may find a great deal. And if you don't, you're going to be in for a tough ride. So those are some things that we would say to account for today.
Yeah, that's a great point. And so much of this is psychology, right? I mean, 6 months ago, so many people would say, oh, if only I would have bought some, this and that at X per door in 2010. Oh my gosh, what would it be worth today, right? But it's easy to play Monday morning quarterback and guess on those things. To know where the numbers are and make decisions after the fact. And it's the easiest thing in the world to do. In the middle of all this fear, just keep in mind that this is going to create opportunity. We don't know exactly what this looks like. It may be something as obvious as, hey, some people can't meet their debt obligations and they're going to default. And there's going to be, banks don't want to be in the business of owning a property. I mean, that's the last thing they want. They just want borrowers that pay. And so if you can step in as a borrower that can pay, you might be on some better terms. I mean, I won't go into details, but we had to walk away from a deal, and it was a certain price point, and that price point changed pretty dramatically after this thing. Now we're still not able to do that deal, but it just obviously speaks to seller expectations changing on certain properties. So that will happen. A couple other things we're going to want to cover, if we can advance the slides here, is what we can take advantage of on these projects, right? And so it's the same business model that we liked 10 years ago and that we still like today, but cash flow is a big one. And people have really beat the drum for years around cash flow, right? Buying things that produce cash flow. So and really this thesis is being tested now, just like it was tested 12 years ago. If you have a property that's valued at X and the valuation changes dramatically over, say, a recession period of 18 months, but it continues to cash flow and then values, pick back up at some point in the future, then you can weather the storm. And that's the position you want to be in with properties that are producing cash flow. They could weather a storm if cap rates change or whatever and valuations change. and still produce cash flow. And that's a great investment. These are not investments we're getting in and out of in a week. So these are multi-year investments. And, you know, my personal philosophy is I don't want a debt maturity anywhere inside of 3 years ever at any time on any property, right? So if you hit a recession on a dime, and I don't know how much of a recession we're going to go into with COVID, but certainly it's going to have an impact. We've got years ahead of us before any debt maturities are there. So you want property that's cash flow. Your equity in that project may go down if the valuations go down, but if you're in a position to not sell and hold on for cash flow, then you can ride that out. We're still getting depreciation on this for our tax purposes. You know, we just sent out K-1s on our properties with big losses. And if you're able to claim real estate professional status, or maybe your spouse is, you can take unlimited losses. I'm not a CPA, but this is what we've seen clients do for years and years, and investors is take unlimited passive losses on real estate. It's really an amazing thing. And now is the time, really, I think the big takeaway for this call is you're not going to write an offer on a deal tomorrow or this week, but you can absolutely use this downtime to get educated and to build your network. That doesn't take, you know, I would advocate not taking the foot off the gas, getting network with your networking and your education, right? Because you can actually use this downtime to propel that and be better prepared. And that's what we're doing at our firm. That's what we're doing at Apartment Educators. Everything is, hey, how can we, okay, we have a little time out here. You know, whole world's taking a little time out. We're going to huddle back with the team. How can we be better for when we get back out on the field? Because we're going to get back out on the field pretty soon. And it's going to be a circus when we get back out into the game, right? I mean, everybody wants just going to be flooding back in, going to restaurants, spending money, wanting to do deals. It's going to be crazy. And so what can you do right now at this time to take advantage? And for a lot of you, that might be your education.
Yeah, a point to add. So, I mean, Devin's spot on when we're thinking about education, how to better yourself right now, growth. It's so easy to get focused in on all the worries, the concerns, the fears that are building up. And, you know, I bet you there's probably not a single one of us that have thought, or that have not thought, man, am I sick, or someone else going to get sick, or how do I stay away from getting sick? And those are all real thoughts. I mean, they're happening, and it's a fear and it's a concern. But I would venture to ask how many people that are watching this right now, are looking at Facebook right now, are actually in that state. If you're not sick, and if you haven't had some extreme worst case scenario pop up, you know, my heart goes out to anybody who's sick or who's lost a job or who's in that situation, right? But if you're not in that situation, you need to ask yourself and think about, well, what am I doing with my time? Am I here? Am I healthy? Is my family okay? And if so, check yes. Well, then how do I need to better myself through this process? And, you know, if your goal was investing beforehand, your goal should not change. You should just figure out how to improve yourself and how to get better. So if that is watching these videos, watching these webinars, you're trying to figure out how to do your underwriting, you're pulling out an Excel, you're trying to figure out what asset management is, you're trying to figure out these new lender qualifications, what makes a good deal, what's going to make a good deal. Now is the time. Take massive action. That doesn't literally mean, you know, invest all your money in an investment tomorrow, but invest something, invest your time, invest in yourself, and go, you know, contribute to making yourself better. And if you do so, man, you're going to be primed, you're going to be ready, you're going to make the best action possible when that time comes, and, you know, you'll be better for it. And then also the government has passed some new regulations and rules. So if you haven't seen some of the 401k, I guess, allowances that they're giving us as investors, if you put money in a 401k, we used to take your 401k money, move it into a self-directed IRA and invest it. Well, I could do that, or I did that because I left my job. Once I left my job, my 401k was free to direct however I want to. But some of you have jobs that have been there. You've been in jobs for a while. You can't do that because you're still employed. Now you can. The government's given up to about $100,000 of allowance from your existing 401k that you can move penalty free if you need to. And for some of you, you know, you may not have the ability to do so, but if you are and you have the ability to, you know, pay your normal daily needs, your requirements to keep going, cool. And then you have an extra 100K or more, you can pull that, invest it. So you're kind of thinking about, how do I use that appropriately when the right deal comes? If it's 3 months from now, 6 months from now, a year, now's the time to educate yourself and then figure out those guidelines on the new 401K. I can pull 100K without any penalties. So that's what you want to get ready for.
Awesome.
Well, I think that was a lot of the meat. We don't want to run too long. We know lunch break. Some of you guys still got to eat food and take your bio breaks and things like that. So we have a couple of just housekeeping kind of items. Our next meetup is April the 21st. We're going to do that in the evening, 6:30 p.m. We'll kind of dive into how apartment investors get paid. So whether you're a limited partner, a passive investor, a general partner, there's a lot of different ways to earn cash flow and increase equity. So we're going to cover that at our next April 21st event. And then if you want to keep up with making sure that every single webinar that we're going to put out there, you can go to facebook.com/apartment educators or the website apartmenteducators.com. If you look under events, you'll be able to see all of the registrations for every event in the future. And we'll probably publish one event in advance at most of the time. So Devin, what else are we missing for this call? Q&A.
Yeah, I think we're going to do a little bit of Q&A. We've got a question here. Can we watch a replay? I believe the answer is yes. So if we do have it and we've got the replay available, we'll send it out if you register for this call. Great question.
Correct.
All right.
Let me see. Anyone else? Any other questions? Sorry, I just kind of hit you out there. I think another one.
We have a question here. Should I wait until this COVID is over? Two answers. Wait on education? Absolutely not. Use the downtime to continue to get educated. Should I wait to put in an offer on a deal? Yeah. Wait a few weeks. I would. And that's what I'm counseling our students to do. It's just too crazy right now, but we think this is weeks. So if you were about to make an offer, yeah, maybe wait on that offer. But everything up to making that offer, there's so much that precedes that in terms of building relationships, education, getting your team together. Maybe it's just, hey, I'm working on my education. Maybe I need to meet one more property management company, and I can do that with a 15-minute phone call. So all that stuff ahead of actually writing an offer, you can still do, right? But yeah, writing offers, I would hold out. I had to back out of my first deal, says Kaylin. Yeah, that's right. Better to back out of it than do a bad deal, right? We had to walk away from a deal. It cost us a lot of money, and I'm very happy with that outcome versus the alternative, right? Especially, and this should go without saying, if there's investor capital in the deal, you absolutely, without question, put investor capital first. So we had to walk away from a big deal and cost our firm a lot of money, and that's totally fine. And we returned some capital to investors and said, hey guys, we're going to live to fight another day, and we'll go and do it soon. But backing out of a deal is probably the better option. What books do we recommend? I like for multifamily specific. Abel, you have any multifamily specific books you're liking right now? I'm a big podcast guy.
I'm on the book specifically. The one that I just like is covers a lot of the different aspects in a lot of detail. Ratcliffe has a pretty decent lifetime for cash flow, investing for lifetime and cash flow. It's really comprehensive, but I will tell you that when you read it, you're going to want to engage with some of those things. It's super hard to read that book or a book like it and then not be able to soak it in if you're not underwriting deals, if you're not looking at properties, if you're not doing the underwriting and you're trying to figure out what would I do differently in this pro forma, in this model, how would I make this work? So whatever book you have, make sure you're taking it and then trying to practice. You're learning your education and then you're applying that knowledge, and maybe read a chapter and take an action. And I think whatever book it is on multifamily apartment complex investing, I think that's a great way to learn. So just kind of an overview there.
Yeah, that's great. So we've got a question here from James. If I want to purchase my first 30 to 50 unit apartment by the end of the year, what are some specific action steps I can take beyond getting educated? I like that question, specific action steps. So do you have a relationship with a loan broker? Do you have a relationship with an attorney? Do you have a relationship with a property management company? Do you have a relationship with an accountant, the whole team? And do you have the equity? I mean, before you pursue a deal, you need to have line of sight on an equity. So I'll just on the equity, let me just say a 50 unit apartment complex. And James, I don't know where you are in the world, but let's just say you're buying it at $80,000 a door. You're looking at, hold on a sec, 50 units times 80,000 a door. You're looking at a $4 million purchase times 0.3, back of the napkin math. You need 1.2 million in equity. That's most of the time, that's going to be a big question for people. So if you want to buy 50 units this year, where are you going to get your 1.2 million? If you're going to write the check yourself, great, problem solved. If you're going to raise it from investors, have you had all those investor conversations? That could be months or years of work, right? So you want to have a line of sight on your $1.2 million equity to get the deal done. You want to have a relationship with an attorney, relationship with a loan broker, relationship with a property management company, and have all that teed up. If you have all that, man, you're rocking and rolling, right? Continue to network and when the time's right, start making offers. But if you don't have all those things, those are some specific action steps you can do. Is find out how you're going to get your equity. And then also on that $4 million deal, you're going to need $4 million in net worth. So if you don't have $4 million in net worth, you're going to need a partner with that balance sheet and liquidity. So that's hopefully enough stuff to work on to get you started, this year. What resources would you recommend learning more about asset management? There's really so much you can do to get the educational component, and then you just have to start doing it. I mean, asset management is reviewing weekly with the property management company how the numbers are looking, KPIs, right? Traffic, leases, budgets, all that kind of stuff. And that's really just kind of basic business components there. And I think at some point you just have to start doing it. Does your team, we've got a question here for Benjamin. Does your team change on every deal, or is it better to find that optimal team and stick with them through a majority of deals? I've told every vendor I've ever worked with, hey, I'd love to do every deal forever with you, if it's good with you, but we're always top grading. And that's just a reality of business, right? If we find a vendor that's better, or some component of it's better, or it makes our investors more money, we're going to go with that vendor, right? So I think it's a balancing act, certainly, but we're always trying to find better team to surround ourselves with all the time. That's just the reality of business. We've got a question from Ryan. I listened to a podcast where syndicators offered limited partners uncapped equity instead of preferred returns. Do you have any of your projects have that model? I do not personally. We have preferred returns on all of our deals that are active right now, and then a split after that. So investors get the first 7 or 8% of any cash flow, and then once that's made whole, they get 75% of the deal after that. That's how we structured it. Not to say that couldn't change in the future, but that's how we're currently doing it right now. I do know some operators that don't do preferred equity, and it seems like everybody has their own reasons. And it seems like whatever school you grew up in or came up in the business in, whether it was preferred return or not, that seems to be what people kind of stick with. And it seems more like a comfort thing that's my observation. Great question though.
Devin, if I can ask you a follow-up question just to answer too. So
Sure.
What's an uncapped equity? Maybe for somebody who doesn't really understand, maybe you can describe that a little bit too.
Yeah, so I think what Ryan means with that question is, let's say we've got a deal where the management team owns 30% of the deal and the investors own 70. Uncapped equity would mean, hey, if the deal just knocks it out of the park, they're going to just continue to get whatever 70% of that thing is. Capped equity, I think what Ryan means in this question is, sometimes you'll see deals where investors get a certain percentage up to 10% IRR or 15% IRR. And then beyond that, they get less of a return. And that really incentivizes the sponsors to overperform, because if they overperform, they get a bigger payday. Whereas some models just say, hey, invest passive investors own this much equity and this percentage, and regardless of how well the deal performs, they'll get their portion of it. And looks like that answered the question. So good. Okay. Yeah, I mean, my personal philosophy is a very simple, straightforward split. I see more experienced operators. It seems like over time, they can get more complicated structures, and that's fine. I always like to be able to sit down, have a cup of coffee with a new potential investor and explain in 15 seconds how much they own of the deal and how they get paid. That's just been my philosophy, and it's just kind of easier to operate that way. Maybe we change that in the future, but that's how I like to structure things, nice and simple. So that takes us about 40 minutes of the call. We want to wrap up. Really thank everybody for spending some time with us. If you want to learn more about getting educated, you can go to apartmenteducators.com. And we look forward to seeing you. And I would love to shake some people's hands here in the near future.
Yeah.
So
absolutely. Absolutely. So at some point we will. There's no doubt about it. It's just when. It's just when.
Yep. It'll be sooner than later, and we'll all be back to it. So look forward to seeing you guys in the real world. Thanks for joining us on the call today.
All right. Thank you, everyone.